It's really interesting. The markets, they're very flexible in terms of what they want to focus on. I'll put it that way. Normally, they would sort of underweight the statistics that are produced by these various government agencies and focus more on what they're hearing from companies. But today is a perfect example of that flexibility, wherein Walmart came out with better earnings than expected because they're broadening their customer base to incorporate people who used to be able to afford it Whole Foods who are now buying groceries at Walmart. So that's a negative sign about the consumer, but it was completely drowned out by this retail sales number. It was not nearly as good underneath as it appeared on the surface. And they did revise down last month. This seems to be the pattern here. You know, you come in, you surprise on the upside with whatever the number is, payroll, employment, retail sales, yada, yada. And then quietly in the next month, you revise the data lower. For example, we got industrial production, which disappointed, but they also revised lower the month prior, which was the 13th out of 18 months that they've lowered their initial revision. One thing that's important to note about these retail sales figures are not adjusted for inflation. In real terms, retail sales actually peaked in March of 2021. So they've been declining basically for 3 years now. And on the credit card front, obviously, we saw this period where, not to go too far back in history, but when we came out of the pandemic and we had all this surplus stimulus that was still in the pipeline, consumers used that money to pay down credit card balances very smartly. And then as soon as the checks stopped coming and they ran out of money, the credit card borrowing started to pick up. And it really coincided with the ramp higher in inflation, not coincidentally. And that was a real warning sign that people weren't being able to keep up with the price of everything they couldn't live without. So they were running up credit card balances just to stay afloat. And they were doing that at 23% interest rates, mind you. I like to describe this as signs that the consumers both spent up and lent up, because into the last 3 months, consumers have not increased credit card borrowing. We actually saw modest declines in their credit card borrowing. So they're just tapped out at this point. They're saying, and you see the delinquency rates, it's no wonder if you're way behind on your credit card debt, you're not inclined to run up the balance even further. So you're really seeing that stress. The delinquency rates are probably the best indicator of it. And then what you're hearing from companies across the board, they're really warning about this clear slowdown in the consumer. Wayfair, I thought, was interesting, ultimate discretionary spending company. They likened the slowdown they were seeing in the consumer to what they saw during the depths of the global financial crisis. And think about that. We're at 4.3% on the unemployment rate. In 2009, we were at 10. So this is a really inauspicious harbinger of what's to come. Consumer discretionary earnings are up 11.9% this quarter year on year. If you take out Amazon, which I'm not a stock analyst, but I believe they make all their money in AWS, not in the doodouts and stuff that I'm buying on the online, retail site. The consumer discretionary earnings go from up 11.9 to minus 3.5. So the recession is here. It's just being masked by a handful of companies. And it's sort of that same Mag 7 story that's, skewing the indices, both in terms of price performance and in terms of earnings growth. And I think that latter part is less widely appreciated, that the earnings story isn't broad-based at all. It's just as concentrated as the price performance is. And you have to kind of look through the government statistics. Here we've seen until this last month, any number of stronger than expected payroll reports that then get revised lower. And then we've also seen this massive gap between the payroll survey and the household survey. And the household survey has always tended to be more reliable at turning points in the economy. And we could get into the weeds as to why that is, but there's some statistical rationale for that. But what's really important to me on the employment front is you've seen what companies did, I think, after COVID was they had so much trouble getting people back to work, struggling to get people who are getting money from the government off the sofa and back, on the job. And so once they finally reached full staffing, their inclination to cut heads as they saw things slowing was very low. They probably figured, look, why don't we just slash their hours while we wait to see if this is a real slowdown or just a temporary, soft patch. And so what we've seen is hours have have been chopped and chopped and chopped to the point that people have had to take on second and third jobs. So you've had this huge increase in multiple job holders at the same time that full employment is actually declining year on year. And that has always been a recession signal. So the full employment component is telling you we're in recession already, notwithstanding, these weekly jobless claims, which have their own sort of issues around them. Bloomberg did a really excellent study months and months ago that highlighted that a very large portion of people who are eligible for unemployment, and my speculation for that is that, the state and local governments got so much money from the federal government from the COVID stimulus that they implemented all these special assistance programs, and they were sending out rebates and all kinds of supports that maybe made it such that people didn't have to take unemployment. Maybe they were getting more generous benefits from their state and local various options. The perils of describing everything with one brush, it's sort of like the consumer, where we look at these average statistics because we have no choice, but there's really no one represented by the average. You've got the high end and the low end, and their experiences are markedly different. The same is true in the corporate space, I might add. I mean, you have a very small segment of companies that are driving the earnings growth, and the rest of them are really struggling, as I mentioned, with that consumer discretionary earnings, difference between Amazon and with and without Amazon. But what you're seeing on the corporate front is not only an issue of them dealing with the same pricing pressures that the consumer's dealing with, especially with the increased regulatory burden they've had in the last several years, plus the higher energy costs, etc. The NFIB small business survey came out earlier in the week and didn't get a whole lot of attention. Within that, they have an uncertainty component. That uncertainty component on a scale of 0 to 100 went to 90. I mean, that's about as uncertain as they get. And in fact, when you go back and look at that and overlay it, not surprisingly, with capital spending, you can't really distinguish the two lines. They look exactly the same. So I think that's part of what's happening here is the election and the uncertainty around what the policy framework is going to be is another dampening factor on the corporate and business activity. I like to look at the government in the GDP accounts. They report profits, and those profits are reported for the entire country, all companies, not just the 500 S&P companies that Wall Street fixates on. And the gap between the earnings growth reported by the S&P and the broader economy really tells you the story. Although I did, just to underscore the point, see an analysis that was, I think JP Morgan did, and they said of the Russell small cap companies, 40% are unprofitable. 40%. 17% of mid caps are unprofitable, and 7% of S&P 500 companies are unprofitable. So again, there's a lot more pain beneath the surface that just is kind of masked by these Mag 7 and the other, stocks that are really responsible for driving the indices higher. We've had this whole student loan attempt to forgive student loan debt. And despite it continually being rejected by the courts, the administration keeps pushing it and they're insisting and they're going around the back door and trying to do that. And what I worry about with that is that it might be sowing the seeds of sort of a moral hazard on Main Street, as I like to call it, where people who have run up all these credit card balances just struggling to maintain their basic existence might say, hey, why is the administration bailing out my neighbor whose kids went to some fancy Ivy League college and ran out of debt, and I have to pay 23% on this credit card debt just so I can fill up my car and put groceries on the table? If we get into an environment where people start to sort of go on strike and not pay their bills, I'm not sure if that's what's happening in terms of the spike of the delinquency rate in credit cards and auto loans. But were that to happen, it would argue for a more severe delinquency cycle than we've seen in prior downturns. So it's something I'm definitely keeping an eye on. And I think it's a real possibility because you've created this psychology, this mentality out there that, you're not really responsible for your debts because the government's going to come and bail you out. The idea that the Fed was going to somehow cut rates in advance of the economy or the markets coming unglued just belied history. The Federal Reserve is always late. They always get it wrong. And so I've just been betting on the status quo, and so far that bet seems to be playing out. We'll see. But I thought this idea that they were going to cut aggressively just didn't square with the going market narrative. I mean, if you think we're having a soft landing, the inflation numbers, albeit unemployment coming down are still above the Fed's target. We've got unemployment 4.3, not exactly, indicative of a really just debilitated labor market. So what's the rationale for the Fed to be rushing in and cutting rates other than to rescue Wall Street, which shouldn't be their job? So I'm highly skeptical, but I do think we'll get a lot of rate cuts because it'll become clear, as it did that Friday of payroll employment, that they are behind the curve, and that, numbers like retail sales is notwithstanding, the overwhelming weight of evidence suggests that the average consumer is in recession already.